We're looking at the VIX right now. It's at its 2025 low. You also gave us your Santa Claus rally picks. One of them is Bitcoin. Now, generally, when the VIX is that low, we hear a lot of talk about a risk-on rally. Do you see Bitcoin rallying over these next 7 days?
I think it could be, Frank, because it tends to be a year where if you're getting liquidity coming back in the market, especially if the Fed injects some liquidity, and that seems to be happening, then the year end for Bitcoin can be pretty strong. And it is the asset class that's really underperformed, right? Especially to gold, as we're seeing new record highs on gold this morning. So I think it has some scope for here to rally into year end.
By the way, you have a wide range of picks, Ben. You got tech and consumer discretionary, Bitcoin, and also Home Depot in particular. I want to go back to that tech trade. We were highlighting the strength in NVIDIA. Yesterday, it was the best stock on the Dow, the S&P, and the NASDAQ on those reports that they'll be able to ship those H200 chips to China coming up next year, possibly in February. When you're looking at some of the skepticism about tech and people trying to pick winners as opposed to just the broader basket, what are you the most bullish about in the tech space? Is it software? Is it chips? Is it the infrastructure players?
I think it's particularly the chips, because as you can tell from the story in NVIDIA, that the moment that chip story becomes more bullish, in this case, they can ship those chips out to China. Those stocks are going up a lot because NVIDIA in particular has the dominance over chips. You can think of Micron, AMD as in that same category. So I think that's the play from here, because that's still really what drives, I think, most of the AI trade as against the infrastructure piece, which seems to be very wobbly because of the debt financing. So I stay bullish on the chip story.
All right. You mentioned the Fed earlier. I know that's really your wheelhouse. Yesterday, we got the GDP report, way better than expected. I mean, so much better than expected. Still backwards looking, still delayed, but a lot better than expected. At the same time, we got that core PCE number. We highlighted earlier, 2.9%. Does that change the path of the Fed in your mind? Does that change the market's confidence that we're going to get those cuts? There's always this debate. Does the market need a cut or not? But it seems like the market really wants a cut, because we saw early trading kind of be wobbly after the GDP report. And I guess then people decided, it's OK, and the markets move higher.
Yeah, it definitely makes it challenging for the Fed to hike, let's say, quicker, faster, because at 2.9%, even though there's somewhat lagged data. But in the end of the day, it's what the inflation currently is. And I think this is what makes this Fed at least cautious to move quicker with rate cuts. And I think this is where the challenge will be in the first half of next year. There's a lot of expectation, especially from the administration, that the new chair comes in and starts lowering faster. And if the economy keeps growing fast, as we've seen yesterday, and it could well be the case because we're in what it seems a productivity boom, and inflation doesn't really change much, then the Fed can maybe cut one time. That's where the market currently is. But as you say, there's more expectation about it. So I think this Fed will be cautious in the first few months. And that may keep a little bit of trepidation in the markets. But I think overall the Fed will deliver on several rate cuts next year.
Where do you think we see that trepidation? Is it in the bond market or the equity market? A lot of people talking about the long end of the bond will respond if they're not in favor of the president's pick for the Fed chair.
I think that's the case. The long end of the curve will be most volatile because, on one hand, if this is an expectation of this Fed chair must cut rates faster, then yields go up a lot because you cut rates faster, you stimulate the economy. Or there's this uncertainty about whether these cuts actually will happen will also cause that volatility. So I think long bonds are not really the place to be. And I think this is why gold continues to have this bid too as an alternative to bonds. I think that's going to stay that way, at least for the first half.